This survey shows that a large share of Americans don't even understand how bonds work across multiple bond categories. These bars correspond to the answer, I do not understand it at all. The bond market matters more to everyday life than the stock market, even though it gets far less attention. Governments fund deficits through treasury bonds. Corporations finance factories, R&D, and payrolls via corporate bonds. Consumers feel bond markets through mortgage rates, auto loans, credit cards, and student loans. When bond yields move, prices everywhere eventually move. Yet for most people, stocks equal investing, and bonds equal boring background noise. It's essential to know that when bond yields rise, their prices go down, and vice versa. There is an inverse correlation. Even if most people don't realize it, a 30-year mortgage is a bond from the bank's perspective. This means people are economically governed by something they don't understand. Retail investors instead focus on stock market highs and equity valuations. This chart shows one of the most misunderstood yet important relationships in macroeconomics. Since the 1970s, U.S. federal debt has exploded upward, while long-term treasury bond yields have trended downward. At first glance, this looks weird. It would appear more appropriate that higher debt implies higher risk and therefore higher interest rates. However, U.S. experience since the 1970s shows almost the opposite outcome. The chart shows that federal debt rose from about $1 trillion in the 1970s to roughly $5 trillion by 2000, $10 trillion by 2008, and approximately $38 trillion today. Over the same period, 30-year Treasury yields followed a long-term declining trend. In the early 1980s, yields were around 14 to 15%. They gradually declined over the following decades, and after the global financial crisis traded near 1%. After 2022, these yields rose again to roughly 5%. Interest rates move with economic growth and inflation. When growth is strong and inflation is high, borrowing costs need to rise to slow the economy and bring inflation down. When growth is weak, rates need to fall to support lending and economic activity. Understanding this relationship is essential. Bonds are simple contracts. You lend a fixed amount of money for a set period of time with known payments and a known value at maturity. If the issuer does not default, the outcome is largely known when you buy the bond. This is fundamentally different from equities. Equity investing is about what something could become, while bonds are about how much time and risk are worth today. At Gleneus, we're always focused on providing you with outstanding analysis. However, none of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Treasury bonds are issued across the yield curve, most commonly at 2-year, 10-year, and 30-year maturities. These maturities do not trade as separate markets. All of them price the same underlying factors. This chart shows short-term interest rates set by the Federal Reserve, known as the federal funds rate. These rates are directly controlled by the Fed. Long-term rates, such as the 30-year Treasury yield, are set by the market. The correlation between the two exists because long-term rates represent the market's forecast of future short-term rates, plus compensation for uncertainty. It is essential to understand that bond prices are determined by the bond market itself. In fact, just like any other asset, they depend on the same forces: supply and demand. Supply is driven by Treasury issuance and government deficits. Demand comes from domestic savers, foreign investors, and central banks. When demand exceeds supply, yields fall. When supply exceeds demand, yields rise. There is no mystery in this mechanism. The impact of long-term interest rates extends across the entire economy. When long-term Treasury yields rise, mortgage rates rise as well, regardless of where the federal funds rate is at the time. The Federal Reserve could cut rates tomorrow, but if the bond market does not believe those cuts will last, mortgage rates will not fall. When long-term rates decline, housing activity tends to accelerate. This chart shows that from the early 1990s through 2021, long-term rates trended downward. Mortgage rates steadily fell, housing affordability improved, and demand for new homes increased. In 2008, this relationship broke down. Interest rates fell, and mortgage rates declined, yet home sales collapsed. The reason was a sudden repricing of credit risk. Credit availability disappeared, which shows that low rates are necessary but not sufficient to support housing. The bond market repriced credit risk, not just interest rate duration, causing housing activity to freeze despite lower rates. After the global financial crisis from roughly 2012 to 2021, long-term rates were suppressed and mortgage rates remained historically low. Housing activity gradually recovered. In 2022, this regime changed. Inflation surged, long-term rates repriced sharply, and the 30-year Treasury yield moved toward 5%. Mortgage rates rose to roughly 6 to 7%, sharply reducing affordability. There has historically been a strong connection between the copper-to-gold ratio and the 10-year Treasury yield. The copper-to-gold ratio is a useful proxy for growth expectations and cyclical demand. Copper reflects industrial demand and global economic activity, while gold acts as a monetary hedge and signals risk aversion. The 10-year Treasury yield typically reflects expectations for economic growth and inflation. What changed in 2022 is that inflation, not growth, became the primary driver of yields. Yields rose, not because growth was strong, but because inflation shocked the system, reaching roughly 8%. The copper-to-gold ratio has been signaling slowing real economic activity and weaker global manufacturing. Foreign holdings of U.S. debt have risen steadily in dollar terms to roughly $9 trillion. This clearly shows the role of treasuries as global reserves, and not some speculative assets. Biggest foreign holder of the treasuries is Japan, which owns over $1.2 trillion in U.S. treasuries. Next is United Kingdom, with $890 billion, and then China, with $690 billion. The essential point to realize is that these countries have also trade and political ties with the U.S. If a massive sell-off of these bonds were to happen, it would have a very negative and devastating impact for prices of those bonds. As you see, bonds are essential from both economic view and investing point of view. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenaeus.